Okay, folks, let's get started. Okay. Everybody have a group? You don't have a group? Who doesn't have a group? No? So you're the only one without a group? Okay, well, email me afterwards. Okay. Everybody have a company? Act like you do. Just nod and say, I'm keeping up, everything's going smooth. Makes me feel a lot better, even if it doesn't make you feel a lot better. Today I want to talk about a number that I think is going to underlie almost everything you do in terms of valuation, which is the equity risk premium. If you remember, on Monday we looked at history. We looked at past data, we came up with a historical risk premium. In fact, we took two shots at the data. The first shot, we just looked at US data going back to 1928 and came up with 3.88% right now, 1928 through 2008. We took a second shot at the data. To get rid of the survivor bias, we looked across markets and we came up about 4%. This is looking good, right? Equity risk premium looks like it should be between 3.9 and 4%. We're converging on a number. But I also said that we're also at a point in time where historical risk premiums might be pretty close to useless. Okay? Before I embark on that question of why they're useless, I want to raise a different issue. With both the US data and the 16 market data, one of the key requirements we imposed was that we needed a lot of data. You can't get a you can get a number with 20 years of data, but remember that standard error in the brackets below? If you have 20 years of data, it's going to basically get drowned out by the noise. So you need a lot of data. And you can already see that for some of you, this is going to pose a problem. If you're working with a Chinese company, an Indian company, a Brazilian company, or even a European company, you're going to find yourself very quickly running out of historical data. So you can't even compute. It's not even a question of, can I use a historical risk premium? You cannot compute a usable premium. So the first thing I want to examine today is how do we come up with a risk premium for a market where there isn't enough data, especially an emerging market where there's a lot of noise. Let me start with the easy scenario first. If we define this 3.88% or 4% not as a US premium or a 16, but as a mature market premium, that helps, right? Because it gives us a base from which we can start. Which also means that we are working in another mature market, Norway, Sweden, Ireland. You ask me, what risk premium should I use? The answer is right there. Use the premium you got from the US or across these 16 markets because it's a mature market. So for every mature market where you don't have historical data, you can fall back on this number and say, if it's a mature market, it has to have the same premium, I'm going to use this number. But let's look at the tougher scenario. What if I came to you with a market which is not a mature market? There is political risk. There is country risk in there. Somehow you want to bring that into the premium. Let's do the easy part first. If I'm using 4% as my base premium for a mature market, in an emerging market, the premium I should be using should be larger. That's kind of a no-brainer. How much larger? Well, that's what I want to start off with today. I'm going to give you 3 different ways in which we can come up with that risk premium for an emerging market. And I'm going to talk about the pluses and minuses and what I prefer to use, but I'm going to leave the choice up to you. Here's the first one, and perhaps the default way in which most people think about additional country risk premiums. Remember we talked about country ratings when we talked about risk-free rates? And we said ratings go with default spreads. Let's take as an example Brazil in 2004. In fact, I'll give you the 2007 and 2009 updates for Brazil so you can see how this number has changed. In September of 2004, Brazil was rated B2 by Moody's, and the default spread for a Brazilian dollar-denominated C-bond, because it used to be called a C-bond, now it's just a dollar-denominated bond, was about 6.01%. I mean, this will work only if you have a dollar-denominated bond. If I gave you a real-denominated bond, you can't compare it to a dollar-denominated T-bond. But since they're both dollar-denominated, the T-bond and the Brazilian government, the difference of 6.01% is the default spread at that point in time for what investors were charging for buying Brazilian bonds. Here's the default approach, perhaps the easiest thing to do. Take your U.S. risk premium, your mature market risk premium, and add 6.01% to it. You're done. The cost of this approach is you're taking a default spread that really is for buying bonds issued by Brazil and transferring it to the equity market. It's not quite kosher, but it's easy. 80% of all country risk premiums I see do this. They just take the default spread, add it on. Many of them do this a second time around. In other words, they use the risk-free rate with the default spread built in, and on top of the mature market premium, they add the same default spread. They double count the risk. So if you're going to do this, at least do it right. Clean up the risk-free rate, take out the default spread, add it onto the risk premium. So that's the first approach. The second approach was popularized by Goldman about 15 years ago. And here's what Goldman does. It says, I know what the U.S. risk premium is, and they look at the historical data and they come up with a number. So for instance, in 2004, the risk premium for the U.S. was 4.82%. That was a historical premium through 2003. Then they look up 2 numbers. They look up the standard deviation, the S&P 500, and the standard deviation in the local equity index, in this case the Bovespa. You see where I'm going next, right? The standard deviation of the S&P 500 was 19%. The standard deviation of the Bovespa was about 35%. They say if you're demanding a 4.82% risk premium for the U.S., which is the standard deviation of 19%, if you're investing in Brazil, your standard or your risk premium has to be scaled up to reflect the highest standard deviation, which gives you a total risk premium for Brazil of 8.76%. If you net out the 4.82%, they're attaching a country risk premium to Brazil of 3.94%. What's the implicit assumption here? That standard deviations measure the risk of an equity market, and that if you have different standard deviations, you should charge. It actually is a pretty logical approach. Here's the limitation of the approach. Think of what drives the standard deviation of a market. Are all emerging markets volatile? What are the things that drive volatility?
Actually, if you look at the Indian VIX versus the US VIX, Indian VIX was trading at 50 and US VIX was trading at 70.
No, but even in general, if you look at emerging markets, what drives volatility?
If the market is not active, like it's not a very...
Yeah. Volatility comes from 2 things. One is how much uncertainty there is in the market, and the other is liquidity, right? Let me give you an extreme scenario. There's a Wall Street Journal article about 20 years ago, this is way back, and they were describing the Egyptian market then. And the Egyptian market, they used to have a blackboard in front of the exchange, and they would write the trades into the blackboard as the trades happened. And they wouldn't fill the blackboard up over the course of a day. Now, if a stock doesn't trade, what's the price at the end of the day versus the price of the previous day? It's going to be the same. Standard. In other words, liquidity is a factor we don't consider here. And using this approach, there are some emerging markets where the standard deviation is actually lower than the standard deviation in the U.S. And if you track this through to its logical limit, then I should be giving the Ivory Coast a lower risk premium than I should the U.S. The dangers of comparing standard deviations across markets which have different amounts of liquidity is that you can attach very, very strange risk premiums to markets. But you can see what they're trying to do. They're saying, let's scale it up based on standard deviation. So now we have 2 estimates of country risk for Brazil. 6.01% using the default spread, 3.76% or 3.94% using this relative equity market volatility. I'm going to give you the approach I prefer, and I'm not going to push it on you. And I'll give you the rationale for why I do it. I use kind of a melded approach. I basically start with the default spread from the first approach, the 6.01%, because there's information there. Investors investing in Brazilian bonds are saying, this is how much risk I see in buying Brazilian bonds. I look up two standard deviations just like Goldman does, but the two standard deviations I look don't cut across markets, they're within the same market. In this case, I look up the standard deviation of the Bovespa and the standard deviation of the dollar-denominated bond I use to get the default spread. My argument is, if one is illiquid, the other is going to be illiquid as well, so you're less likely to have liquidity problems if you stay within the same market. That's an assumption, you can test it. In this case, the standard deviation I got for the Bovespa was the same that Goldman got, 35%, but the standard deviation of the dollar-denominated bond was 26%. I use the same logic that Goldman uses, but now I'm comparing the default spread on the bond to the equity risk premium. So I take the 6.01%, which is what I'm charging for the bond. I scale it up to reflect the fact that Brazilian equities are more riskier than Brazilian bonds to give me a total country risk premium of 7.89%. Let me emphasize, this is on top of the U.S. risk premium. This is not the total risk, this is the extra risk premium, but you can already see what I'm doing is I'm scaling up. Here's my intuitive rationale for this. You're an investor. If you can make a 6% default spread for buying Brazilian bonds, you'd be crazy to go out and buy Brazilian equities and settle for less, right? I mean, to me, it seems illogical that I would charge a lesser risk premium for buying equities when I can buy a bond and make a larger default spread. Well, the only worry I have is default risk, because whatever you worry about default risk is going to get magnified in the equity market. Okay? Because if you're saying there's a lot of default risk here, that's why I'm charging the large, what do you think is going to happen if the country defaults? You think your equities are going to be protected? Think of Argentine equities in 2001. When one, when one goes south, the other is going to go even further south. Okay? Yeah.
No, I was just going to say regarding that sometimes, as you said before, bonds on the company might be have a smaller default than the government itself.
That's right. So that's right. But I'm still comparing how, so that's possible that if every Brazilian company then is like Embraer, then,
quite a few.
well, as a proportion of the economy, if you say that might be a scenario where you could actually argue that maybe the volatility of the equity market could, but then it should show up as lower volatility, right? So that's really the question is, if that is the case, why doesn't it show up in the standard deviation numbers? So again, the three choices, you come up with three different numbers. The third approach, you're kind of melding the default spread. And you're saying, what if my country does not have dollar-denominated bonds? You see what I'm saying? Brazil, life got easy. I gave you the dollar-denominated, the spread on the dollar-denominator, you built on that. What if you just had a rating? Take India. India doesn't have any dollar-denominated bonds. It has a rating. Could you use the rating with the same approach? What would you do differently? What did I do with the risk-free rate? I took the rating and I estimated a default spread based on the rating. In other words, if you cannot find a dollar-denominated bond or a euro-denominated bond issued by the country, go back to the rating. That rating should give you a default spread. That default spread can be scaled up. What if you don't have a rating? Don't even think about investing in that country. I mean, I'm just kidding, I checked the kinds of countries where you don't have ratings. There's a big chunk of Africa where you don't have ratings. So in fact, you go below sub-Saharan Africa. North Africa, you have lots, Egypt is rated, Morocco is rated, sub-Saharan Africa. But the reason there's no rating is there's so much uncertainty there that the ratings agencies don't even know how to attach a rating. So then you're in real trouble. Then you got to go look for something else. We'll talk about some, because remember the rating here is why? It's an intermediate step, right? I really don't care about the rating. I need the rating to come up with a default spread. If you don't give me a rating, then I'm going to look for some other measure that measures country risk. Here's one. You ever seen The Economist actually has these country risk scores every 6 months? They reported in the, you go to visit the website. I took an example. In fact, I'm going to give you, send you a paper. You read my risk-free rate paper, right? This is going to be a quiz at the end of the session. No, actually not. Okay. I'm going to send you my equity risk premium paper. It's a practitioner paper. It's not an academic paper. It's completely about estimation. And there actually I took an example, I think of Kenya or a country that did not have a rating. I looked at the Economist country risk score because the Economist actually, I looked for another country with a similar score which was rated. And you can already see what I did next. I mean, you're saying this is desperation time. You are in desperation. I mean, when you can't find a rating, the alternative is to say, well, there's no country risk here, I can just move on. You have to come up with a number. So do whatever you need to come up with a country risk premium, because without it, you're not going to be able to continue with the rest of the analysis. Here's an update. January 2007, Brazil had a pretty good 3 or 4 year period between, not just Brazil, this is in fact true across emerging markets. And it showed up in 2 places. One is the rating for Brazil improved to B1 from B2. And the default spreads across the board dropped off for any given rating. So you're getting a double whammy. In fact, in January 2007, the default spread in the Brazilian dollar-denominated bond had dropped from 6% down to 1.5%. Why did this happen? This was part of a kind of a bond market problem, right? Default spreads across the board were dropping. People were assessing less spreads for the same default, 1.5%. I did exactly the same thing I did in 2004. I looked up the standard deviation of Bovespa, standard deviation of the dollar-denominated bond. Now the Bovespa is twice as volatile as a bond. Multiply 1.5% by 2. My country risk premium for Brazil has dropped from 7.89% down to 3%. Let's make this real, right? If your country risk premium drops from 8%, almost 8% to 3%, holding everything else constant, what's happening to the value of any given set of cash flows in Brazil? The value of any given set of cash flows is going to increase exponentially, right? Take a look at the Bovespa between 2004 and 2007. Brazil actually did not grow that far. Brazil is not India or China. It didn't have double-digit growth. Its real growth rate actually is pretty moderate. What caused the Bovespa to kind of explode out was equity risk premiums dropped. And this is actually a phenomenon you saw in emerging market after emerging market between 2004 and 2008, is as equity risk premiums or country risk premiums dropped off for emerging markets, the indices in these markets all exploded out. Now we'll see what happened after September of 2008, but you can already see how much country risk can drive the value of equities in these markets. January 2009, it's almost a different world now. Okay? Its rating actually improved. See, this is good. But the default spread was now 4.1%. So higher rating, but because we talked about risk premiums and default spreads widening out, it showed up as a higher default spread in January 2009. Which in turn, if you use the same scaling mechanism, translates back into a country risk premium bouncing back from 3 to 6.77%. The Bovespa has lost half its value in the last 6 months. In fact, it's lost more value than the S&P 500. This is actually one of the big mysteries you see in the journal. How come if this is a U.S. banking crisis, are emerging markets being hurt more? In fact, in emerging market newspapers, this is made to be some kind of conspiracy. Okay? They're convinced that there are some U.S. investors out there driving these markets down, as if U.S. investors out here have any time to do anything but panic on their own territory. But this is not so much a U.S. banking crisis as a risk crisis, right? When you have a risk crisis, the riskiest asset classes are going to feel the heat more than relatively safe asset classes. And guess what? You gained on the upside, you're going to lose on the downside. That's what you see in the country risk premiums. So at the start of every year, I do this. I've been doing this for about 10, maybe 12 years now. So this is, I tell people up front, I'm not the economist. I don't have a staff. I don't visit Namibia and check out the risk. I don't know what the Moroccan risk is. I just take the Moody's ratings for these countries, use my approach, and come up with country risk premiums. So these are the country risk premiums January 2009. So take it for what it's worth. It's purely mechanical. I'm taking the rating, coming up with the default spread based on the rating, and scaling it up. So as an example, right? India's country risk premium has increased to 6%. That used to be 2.5% a year ago. It's up to 6%, or 3% a year ago. It's now up to 6%. So I did this for every country. I did not realize that this was being used. I mean, the first time I realized it was being used in places I didn't expect it to be used is I got a call from the Colombian government saying, your risk premium is being used in a privatization. How do you justify the number? And I said, why would I want to justify? I'm not even getting paid for this. But here was the icing on the cake. I get this email 3 days ago. It's from Lebanon. Okay? And the first line of the email got my attention. He said, "You have destroyed Lebanon." I said, "I destroyed Liechtenstein, I can understand. Maybe Luxembourg I could get away with destroying, but Lebanon, after what it's been through for the last, I was the one who destroyed Lebanon? Not the Christian Phalangists, not Hezbollah, not any of those other, I am the one? I didn't even realize I had this much power, so I keep reading the email. I mean, how the heck did I destroy Lebanon? It says, "You have given us 11% country risk premium, this is completely unfair." I say, okay. What do you want? And then it goes on. "You have to reassess this number and come back with a lower risk premium." So I said, first I'm a little wary about sending off an angry email to Lebanon. Who knows where that'll end up, right? So I sent him the email back saying, "Look, I've never been to Lebanon. I don't know Lebanon that well. You know it better than I do. But here's all I did. I took the Moody's rating for Lebanon and I scaled it up. If you have a problem, it's not with me, it's with Moody's. And here's the address. Leave me alone, right? So I want to be very clear. This is not a deep qualitative analysis, but it has one thing going for it. I'm not playing games here, right? I'm not passing subject. I like this country. I don't like this country. So in a sense, I'm letting the numbers fall where they might. The weaknesses, I'm building off a rating, and we know ratings lag reality. It's not that they're necessarily wrong, but that they lag. It takes them 6 months, 1 year, 1.5 years to get around to it. So it is what it is. Okay. So if you see a country up there, you get really upset about it. 70 Church Street. That's for Moody's address. Go in there, make a lot of noise. Just don't come into my office and yell at me. Yep.
Yeah, you use the standard deviation of the dollar-denominated bond. So if a country has a local bond market,
You could use that instead. So basically, it's a standard. So in a sense, I will take whatever I can get. I'd start with my best case scenario. That's why, in fact, you might want to read the equity risk premium paper, because I describe in detail the kind of the making of the sausage. It's not, I mean, basically how I come up with the spreads. I show you the CDS spreads, because in the same rating, you get 4 different countries with the same rating, different spreads, basically what I did when they had different spreads. But I also talk about what do you do when you don't have a rating? What do you do when you don't have a default spread? What can you do if you don't have a dollar-denominated bond? And I'm not suggesting any of these is the final solution, but I'm saying we have to start thinking about this from scratch. We can't just take, back of the number, back of the envelope numbers that we've been using for 5 years and say that's my risk premium forever. Okay. Any questions on country risk premiums? Yes.
Where are you getting the standard deviation, for example, Lebanon or the bond market?
If you go to Bloomberg, you pick any traded security index, whatever it is, and type in HVT, historical volatility, HVT. It'll actually give you, initially the default is it'll give you a 100-day standard deviation. If you don't want to stick so much on a 100-day, I just change the day to week, and it'll actually do a 100-week standard deviation. Which is, I don't want to go too far back, because I want to capture the market as it is today. Okay. But make sure you use the same 100-week window then for both the bond and the stock. But that's all I did, is I that's the saving that Bloomberg did. It's not that they do something special, but they have the raw data in there. They compute the standard deviation based on that number. Okay. The alternative is to use implied numbers for both. Right? The VIX we talked about is an implied number. That's going to be much more difficult to get for a country like Lebanon, because if you don't have options, you don't have futures, you will not have implied numbers. The nice thing about implied numbers is they're more forward-looking, unlike historical numbers. But since you're looking at the ratio anyway, I don't think it matters that much. Yes?
What is the 0% risk? Is it relative or is it an absolute?
0% what?
0% risk.
Country risk? It's not 0% country risk. You still charge a mature market risk premium, right?
I mean, is it the best that a country can get in terms of risk, or is it an absolute?
No, it's got nothing to do with the country. It's with you. It's you as an investor and what you would demand as a risk premium, right? This has nothing to do with what countries are earning. It's what you and I demand for investing in stocks. So we're starting with a base here. We're saying there are these 21 countries which we regard as mature markets. We'll demand the same risk premium for those 21 countries, not across time, but at a point in time. Because if you did not charge the same risk premium across these countries, money would flow out of one country and into the other. So that base premium is a negotiable number. You might not like the 4, but that's the starting point, and then we're building on top of that. So we're not saying there's zero risk, but we're saying those are mature markets where at least all they do is compete for capital based on how good the investments are in the countries. But in emerging markets, you got to deliver something extra to pull investors in. Okay? So that's what this is the extra number over and above the mature market premium. Any other questions? Okay, so I did not destroy Lebanon. Okay. So now we have a country risk premium. Whether you like it or not, I have a number, right? Now I want to ask you a follow-up question. There are three things I can do with the country risk premium. The first is what I call the bludgeon approach. You know what the bludgeon approach is? I take every Brazilian company and say, you're a Brazilian company, too bad, here's 7.89% for you. Basically, I'm arguing that every Brazilian company is equally exposed to country risk. That again is the default approach that most investment banks use with companies. The nice thing about the approach is you tell me where you're incorporated, you're sunk. That's it. Now you're an Indian company, this is your country risk premium. It's almost karma in country risk. You were born here, you can live here, this is it. So you can't do much about it. Which strikes me as extremely unfair, because not all Brazilian companies are equally exposed to Brazilian country risk. So I'm going to suggest a refined bludgeon approach. What's a refined bludgeon approach? It looks like you're doing something refined, but it's still a bludgeon. See that country risk premium? I'm going to move it into the brackets and multiply it by a beta. Sleight of hand, right? Because what have I done now? If you're a high beta company in the market, I'm saying you're more exposed to country risk. If you're a low beta company, you're less exposed. It's not that outlandish. Beta, after all, measures the exposure to macroeconomic risk. I'm assuming that country risk is correlated with other macroeconomic risk. It's kind of an assumption. But the advantage is I move it in, and then within the same country, you could have different exposures to country risk based on your beta. But you can already see the problem with that is you're asking beta to carry one more load on its shoulder, right? It does all the other work. Here's one more thing. Take it on your shoulder. So the third approach is my preferred approach, and I'll talk about it, at least for some companies. I'm going to take the risk-free rate. What risk-free rate? That depends on what currency you decide to do your valuation in. Brazilian reais, US dollars. So that has nothing to do with this particular part of the process. I'm going to take your beta, which measures your business risk. So if you're a steel company, I'm going to say this is your beta. If you're a chemical company, this is your beta. At this stage, I'm not even looking at whether you're Brazilian, Indian, Chinese, Indonesian, or US. So beta is a measure of your business risk. I'm going to multiply it by a mature market premium. It says US there, but basically I'm saying that's a mature market premium. So if I stop there, I would now have the expected return for a mature market steel company. Then I say, okay, you're not a mature market steel company. You're Gerdau Steel. You're a Brazilian company. I'm going to now bring in a third factor here, which is the country risk premium. But I'm going to scale that risk premium by how exposed you are to country risk. And I'm going to call it a lambda. Why lambda? Because putting Greek names on things always seems to impress people. You notice there's a lot of... The only people who are not impressed by this are the Greeks. I mean, they accuse us of kind of hijacking their alphabet, and they're right, you know, beta, alpha, omega, theta, and the option traders just go crazy with this stuff. But basically, the lambda is going to look a lot like the beta. A lambda of 1 means you're as exposed as the average Brazilian company to country risk. A lambda less than 1 means you're less exposed. Lambda more than 1 means you're more exposed. I'll give you the story behind lambdas. It came to me on a flight to Brazil about 8 years ago. This is a very long flight. For some reason, I don't know what, to save money, I think, I flew TAM. And I had to fly through Miami. And they landed, they were supposed to go all the way to Sao Paulo, but they landed somewhere in some other country, Guatemala. And we were on the ground for 3 hours, and soldiers were coming in and out. So I had a lot of time to work, so I was looking over the presentation. The two companies I was valuing from a Brazilian seminar were Embraer and Embev. For those of you not familiar with Embraer and Embev, Embraer is a Brazilian aerospace company that gets 97% of its revenues outside Brazil, Western Europe, North America. In fact, if you've flown a short, for instance, if you fly to New Hampshire on a flight, you're probably flying an Embraer jet, so small 30, 35 passenger jets. So it gets most of its revenues outside Brazil. Embev, on the other hand, very well-run company, but it's a beverage company. It gets, at that point in time, it's got almost 90% of its revenues in Brazil. And I was doing the old-fashioned thing, which is adding the same country risk premium for both companies, ending up with these huge costs of equity. So I pulled up the, since I had time, I was looking over the annual report for Embraer, and they had a pie chart of where their revenues came from. And for some reason, I also had an annual report for Boeing. I think I might have been doing a revision of one of my corporate finance books, and Boeing is one of the companies I use. And in their annual report, they had a pie chart of Boeing's revenues. So I put them next to each other. And you know what? I couldn't tell them apart. They look very much the same in terms of where the companies got their revenues. And it struck me as incredibly unfair that I was charging a 7% cost of equity for Boeing and an 18% cost of equity for Embraer, simply because one company was incorporated and had its manufacturing plant in Brazil, and the other company was incorporated, it used to be Seattle, but now Chicago. And I don't even know where its manufacturing plants are. It used to be all around the Washington State area, but it's kind of spread out around the world. So, since I had a lot of time on my hands, I came up with this particular page, Lambda. So I went to Brazil and I made this, and I suggested this, and people nodded, makes sense. And they, of course, asked me the logical follow-up question, which is, how the heck are you going to measure lambda? And I said, it's been a long flight. I didn't get a chance to think about that, but I have a long flight back. I'll think about it then, and I'll get back to you. And I really did think about it, and in fact, there's a paper on my website. You want another paper to read? Hey, go on there. It's about estimating company risk exposure to country risk. Basically, what are some of the things intuitively you'd want to look at to come up with a lambda, and how would you measure it? Okay, so you can help me out. Help me write the paper. So you're trying to measure how much a company is exposed to risk in a country. What are some of the things you're going to look at? One is revenue, right? Would you stop there? What else would you look at?
Taxes.
Well, you're worried about taxes, how much they're subject to, but that I can build into the cash flows, right? If taxes in a sense, you're saying uncertainty about taxes. Okay, uncertainty about taxes. What else?
I think the cost of labor is a part of.
Or where your manufacturing plants are, because that's going to tell me a lot about, so where are you manufacturing? How flexible are you in terms of moving those plants, right? Do you see why that matters? If Embraer got really worried about Brazil's stability, the next plant it might decide to build in Venezuela. Well, that might be jumping out of the frying pan into the fire, but somewhere else. But if Petrobras got really worried about Brazilian country risk, what the heck is it going to do? It's a problem actually that natural resource companies have. Petrobras can say, well, you know what, I'm really worried about Brazil. Let me pull up the reserves and move them to Miami. It doesn't work that way. Natural resource companies, in a sense, should have higher lambdas, other things remaining equal, than companies which have some flexibility. Financial service companies, much more flexibility. The Nigerian oil company can get as worried as it wants about Nigerian country risk, but there is no way it can get away from that country risk. So I'm going to look at revenues, I'm going to look at where your manufacturing facilities are, I'm going to look at tax uncertainty. I don't even want to bring nationalization into the issue, because that's kind of let's leave that out, because that's a discrete as opposed to a continuous risk. We'll talk about why that might matter. Right? There's an easier way of dealing with it. And I might also want to look at your risk management product, because after all, you can buy insurance, you can buy derivatives. I want to know what options you use, futures, what insurance policies do you have. So in effect, I'd like to look at all three before I make my judgment. Yep.
Is that case that even though you receive revenues from abroad, you have the currency exchange risk, while a company that owns like the 90% of its market is in the domestic
But
market doesn't have that risk?
That is, the exchange rate risk is always an issue, right? So even if Boeing invests in Germany, there's exchange rate risk. The reason exchange rate risk doesn't worry me as much as political risk is, A, if you really were worried about exchange rate risk, you can hedge your cash flows, right? Build in the cost of hedging into your cash flows and bring it in. So it's actually a risk that I can deal with much more easily, much more specifically in my cash flows. The risk I'm really worried about is the risk that I cannot hedge against easily, right? The example I give is, remember the Thai Prime Minister came here to the UN meetings 2 years ago? Does anybody remember what happened after he came to the meetings? He couldn't go back. That is country risk. Think about it, if the Prime Minister of the country can't go back into the country, how the heck are you going to get cash flows out of the country? Because that's all you're looking for, right? Cash flows, he can't go back. Your cash flows are not coming out. So the risk I'm much more worried about is that kind of discontinuous risk that's much more difficult. So you're right, exchange rate risk is kind of an undercurrent here, but exchange rate risk I can build into expected exchange rates, and if I'm really worried, build it into forward rates, build it into costs. Now, but I don't want to build into discount rates, because that would mean any time I invest overseas, I will have a higher discount rate for the same project than if I invest domestically. And a lot of exchange rate risk is diversifiable risk. My investors don't want me to attach a higher discount rate just because I'm investing in Western Europe as opposed to the US, because they have 100 companies in their portfolio where exchange rates cut in both ways. So you're right about the exchange rate risk, but that doesn't worry me as much as that underlying economic risk, real economic risk. Okay. So I told a nice story, but I was halfway through the paper and I still hadn't come up with a way of estimating lambda. They still wanted a number. So here's the most simplistic way I had of estimating lambda. Of those three things that I just listed on the previous page, which one can you routinely get from most companies of the piece of information? Revenue. Everything else you might get, you might not get. In fact, risk management products you almost never get. You might never get a mention of it here or there. Okay? Manufacturing facilities, I mean, maybe you can back out. Some annual reports describe it. But the one item you can guarantee that you can get is revenues. So I said, let me start with the most simplistic measure. I will tell you at the outset that this is not a complete measure. You're going to look at it and say, well, that's not going to capture everything. Of course it's not. It's just the top line. And here are the two numbers I look up. I'm going to look up the percentage of revenues that this company gets domestically, and the percentage of revenues that the average company in that market gets domestically. So as an example, when I did this for Embraer, and I did for Embraer and Embratel actually, and as well as Embev. Embratel is a phone company, gets 100% of its revenues in Brazil. Embraer, of course, gets 97% of its revenues outside Brazil. So 3% of the revenues for Embraer come from Brazil. The typical Brazilian company gets 77% of its revenues from Brazil. 3 divided by 77 gives me a lambda of 0.04. 100% divided by 77 gives me a lambda of 1.3. So how can the lambda be greater than 1? It has to be, right? For every company which has a lambda less than 1, there's got to be some other company on the other side. Otherwise, country risk has, I mean, it has to go somewhere. You can't say every company is less exposed to country risk, because where's the rest of country risk going to flow? I'll also make a confession. I think this number understates the country risk in Embraer. You know why, right? Because the manufacturing facilities are still in Brazil. If Brazil goes to hell in a handbasket, I don't care if 100% of your revenues come from outside Brazil, you're exposed. So I will concede the weaknesses, but the strength is it's quick, it's easy, it can be done. The only number actually that will give you trouble is which one? The 77%, right? What are the two ways you can get the 77%? One is the long way, which is look it up for every company, average it out. And actually it's doable. In a country like Brazil, if you pick the 200 largest companies, because it's after all a weighted average, and do it. In the paper on this, I was too lazy to do this because I was doing every country, and there's no way I'm going to go into each country and do this. So with Capital IQ, I think it might be doable. Try it out if you have access to. I mean, you all have access to Capital IQ. Here's what I did to cheat. I went to the World Bank's website. On the World Bank's website, they tell you what proportion of each country's GDP comes from exports. You see where I'm going next? So they say 20% of a country's GDP comes from exports. I said, you know what? Maybe 80% would not be a bad number to use. So you can take it or leave it. But the advantage of that approach is, World Bank website, you're done. Move on, right? Blame the World Bank if something goes wrong. This is always good to have. There's somebody else to blame. But here's the other thing that comes out of this definition of country risk. So we've got Embraer and Embratel, right? What if I told you that 5% of Verizon's revenues come from Brazil? I mean, after all, this is a fact of globalization, right? Companies are getting revenues from abroad. Using this approach, I would now get a lambda for Verizon. And to estimate a cost of equity for Verizon, I have to take the risk-free rate plus beta times risk premium plus lambda for Brazil times Brazilian country risk. Oh, by the way, I forgot. Verizon is also in Venezuela. It is in Spain. And you can already see that this is the nasty side of globalization. Life has become a lot more complicated. But it's reality. A company's risk exposure shouldn't be determined by where it's incorporated. That's silly. You see why it's silly? Because then to get rid of emerging market risk, all I have to do is what? Move my headquarters building, change my listing. And don't be surprised if you see CFOs use this argument. I actually talked to a CFO of a South African company once. And in the early 90s, a lot of South African companies delisted on the Johannesburg Exchange and relisted on the London Exchange. These are gold mining companies. So I asked the CPO, why do you do this? Expecting an answer like more liquidity, which I can understand, bigger investor base. He said to get rid of country risk. I said, what? Is that easy? What do you plan to do next? Pull up those gold mines out of South Africa, put them in the middle of Yorkshire or Lancashire or somewhere? You can't get rid of country risk by just changing where you're incorporated, where you trade. But I think the way we treat companies, that's exactly what we encourage them to do, right? Because if you're lazy, you treat country risk based on incorporation. You're saying you're a U.S. company, there's no country risk. It makes no sense, but a Coca-Cola or a Nestle should have a country risk premium. It is messy, though, because if you're in 55 countries, you can't do 55 lambdas. Or you might be, but I can't. Yep. Beta will never do it. In fact, beta often moves in the opposite direction. Beta is actually a very poor instrument for capturing country risk, at least over short periods, because all you need is for that country to do well while your country is doing badly. No. But if it has Chinese revenues or Indian revenues, the fact that it has emerging market revenues and emerging market earnings actually, because beta measures both how volatile you are as a stock and your correlation with the index, right? So betas are actually, it's very difficult to capture country risk in betas. I've heard analysts say, well, my beta does it. I challenge them to show me that the beta does it. Because you look at companies with emerging market risk from a purely beta standpoint, the beta often goes in the wrong direction. So if you follow the beta, you'll actually end up with a lower cost of equity for a company that gets 80% of its revenues in Asia, then gets none of its revenues in Asia. Yes?
What if the country is a commodity producer? So the lambda for a firm that is not commodity producer is going to be really high.
Why though?
Because commodity producers are always exporting, so
Right.
maybe
Oh, I see. With this approach, you're absolutely right. Because with this approach, we're focusing. Do everybody get a point? Because I'm looking at. So let's suppose you're in a country where half the companies are commodity producers and export 80% of their product, and the remaining half of the companies are companies that produce goods and services within that country. Using this approach, the lambdas for those companies will be huge, and the lambdas for the commodity companies will be tiny. Problem, I think, is focusing on revenue. You miss the fact that the commodity producer actually has this huge country risk factor, that they can't flee the country even in the worst of times. So that's a weakness of the approach. You're focusing just on the top line. You're missing all that other information. Okay? But as a starting point, there's no reason why we can't start here. Okay? Yep.
For the US, can we not create a US lambda for just commodity, for emerging markets? So, for S&P 500, how much export is happening to emerging markets will be the denominator, and the top line would be
you could. Life is complicated enough. You don't want to go there, though. I mean, in a sense, it's better to do this on a company-by-company basis rather than have lambdas for entire markets, because those lambdas can shift fairly dramatically from period to period. But I can see where you're going. I mean, you could come up. Yeah, you could actually argue that the expected return on the entire S&P 500 should have a country risk factor in it, and we're not building that in, right? So there is a lambda for the entire S&P 500, which is the weighted average of the lambdas of the companies involved in the process, the composite number. Right? So what would you like to bring in? You'd like to bring in manufacturing and the costs into the picture, right? So if you bring in, revenues and you bring in costs, what do you have? Revenues net of costs is? Oh, earnings. If I looked at earnings, this would be better, right? Because then I'd catch both the top line and the cost structure. So my second shot, I did look at earnings, but I very quickly gave up, because earnings, after all, have two problems. One is they're not measured continuously, so they're hollow. And the other is there's an accounting smoothing factor that at plays. Accountants love to spread stuff out. They don't want to admit to a loss of $2 billion. They take the loss of $2 billion and spread $400 million this year, $400 million. So they have this fixation about spreading things out, depreciating things, amortizing things, which screws up earnings numbers. So I went to a number that was beyond earnings. What's the present value of your cash flows over time? And cash flow should be revenues minus costs. You take the present value, should factor it in. So stock price should have everything in there, right? In fact, when we run a beta regression, we regress returns on the stock against returns on a market index. I ran something very similar to a beta regression, but instead of regressing returns on the stock against returns on a market index, I regressed returns on a stock against, remember that dollar-denominated bond I gave you for Brazil, the C bond? And I said the spread, the default spread on the bond is going to go up and down depending on what people think about it. What I was trying to do is, how sensitive is this stock to changes in country risk? I want to kind of isolate that factor. So I took, for instance, Embraer and Embraer, and I ran the regression against the returns on the C bond. So the way to read this is, when the return on the C bond is a very negative number, that was a very bad month for country risk. Your country had, what did your stock do? The slope of this line, just like a beta, is going to give me the lambda. So in this case, for instance, when I regressed Embraer against the C bond, the slope of the line is 0.27. What does that tell me? For every 1% move in the C bond return, Embraer's returns moved only 0.27%, reflecting the fact that it is all this outside stuff kind of. In contrast, look at Embraer. For every 1% move in the C bond return, its returns move 2%. Now this all comes with the standard qualifiers. These are regression coefficients. There's a standard error associated with them. But you're looking at a much fuller number when you look at prices. It's not just 1 year's earnings. It's not 1 year's revenues. Look at a much fuller number. It's something that I'm working on refining because I'm not happy with the standard errors. The standard errors are too large for me to use. So I use this approach only in exceptional cases, like an Embraer, like an Infosys. Companies that get the bulk of their revenues outside and I feel are being unfairly assessed based on the existing approach. Yeah?
Don't we double count a little bit the risk premium for Invertel, for instance, because the C bond and the Bovespa index?
That could be. But the double counting shows up only in the risk premiums, right? Double counting can't show up in the betas. It will show up in the risk premiums. So as long as I separate the mature market premium for the country risk premium, I don't think I'm going to push up. Both the betas and the lambdas don't get pushed up by this phenomenon. As long as the risk premiums I use don't end up double counting. No.
But here is both the C bond and the Bovespa, they will...
Oh, you're saying if I use the beta from the Bovespa. That's a good point. I would never use the Bovespa beta in the previous page, because how did I define that beta? It's a beta for the business you're in, and a beta for Embraer against a Bovespa will give me junk, right? So we'll talk about it. I'm not sure that's going to save you either. That, in a sense, that might seem like a solution, but that comes with its own set of problems. We'll talk about that. But we will do an end run around it. That's a fixable problem. Yes? I use weekly. I don't like using daily returns for any regression around. Daily returns, especially in these markets, are incredibly noisy. They're rolling in what sense? I don't count the same observation more than once. So basically it's 100 weeks. So each week gets counted once. Yeah, don't do a rolling, because you'll be double counting. What you're ending up doing then is double counting days, right? Quadruple count, because the same day gets counted in 5 consecutive returns. So even though it looks better statistically to do it, it's actually cheating, because you're taking the same data and counting it multiple times. Right? So this is just consecutive weeks, 100 weeks, one regression. Okay. So that's my Lambda paper, so keep working on it. It's a work in progress, so you guys can pick up from here, because I'm too lazy to go on. Right? So now I've got a Lambda, right? I'm pretty much ready to try all three approaches. Let's see how different the numbers are. First approach, the bludgeon approach, let me go back to 2004, and I had that 7.89% country risk premium for Brazil. 4.82% was my mature market premium. So those numbers are kind of fixed. With the first approach, here's what my dollar cost of equity would have looked like for Embraer using the bludgeon approach. Risk-free rate, T-bond rate. Beta is the beta for aerospace, the aerospace business. I still haven't told you where I got that, but think of that as a beta being in the aerospace business. So that's going to be pretty similar for Boeing. Boeing is going to have a beta pretty close to 1.07 as well. 4.82% is a mature market premium. Plus 7.89%. Why? Because Embraer is a Brazilian company. This gives me 17.34% as my cost of equity. Second approach, I just moved the 7.89 into the brackets. Since the beta is slightly above 1, that pushes up my cost of equity a little bit to 17.89. So with those two approaches, I'm ending up with a cost of equity, a dollar cost of equity between 17 and 18%. Let's see the Lambda approach. I used the 0.27 from the previous page, the kind of price Lambda. So 4.29% beta times risk premium. Was the Lambda. In fact, you can see the first approach is a subset of the third approach, right? First approach, I'm just assuming the Lambda is one for every company. The third approach, I'm just giving different companies different Lambdas. The cost of equity end up with, that's a big difference. That's a 6% difference in the cost of equity. And here's why it can affect your investing. When I used that 17.34% in 2003, 2004 to value Embraer, Embraer actually looked slightly overvalued, right? Because basically what the value I came up with reflects the high discount rate, the price. When I used 11.58%, Embraer looked very undervalued. So it depends on, so you're saying, well, if the rest of the market is using 17.5%, then maybe I should go with that. That's one way to look at it. The other way is that there is an underlying reality here. The reality is Embraer is not as exposed to country risk as a typical Brazilian company, and the truth will eventually come out as the earnings come out, the cash flows come out. But that's a long-term vision. Don't expect it to happen tomorrow. People are not going to wake up tomorrow. But it's actually a way of thinking about country risk that deviates from the norm. And there are places in this class where I'm going to say, this is what most people do, and this is what I think should be done. I'm not arguing that what I think should be done will happen, but I'm saying sometimes going against the grain, going against what people do, could potentially be an opportunity. Because if you buy into this notion, and if you accept the fact that most investors are lazy, or most analysts are lazy, they assign risk based on where a company is incorporated. And you believe different. You believe that risk should be assessed based on cash flows and earnings and where the business is run. Here's my question for you. Okay? If you use this across the board, not just Embraer, let's suppose you want to get some diversification going. You take 100 companies like Embraer, and I'm sure you can try this out. Take every country, take two or three companies, which will fit into this. Avoid commodity companies. As I said, commodity companies to me are dangerous because even though their revenues might all be in dollars, they still are very dependent on country risk to for everything to play out. Okay? Here's my question for you. If you value companies using the conventional approach and then you revalue them using your approach, which of these are you going to more likely find? Emerging market companies with substantial exposure in developed markets will be significantly overvalued by equity research analysts or significantly undervalued by equity research analysts. They're going to be undervalued because they're using this high discount rate. Now comes a tougher question. How can you make money off this? Seems like a no-brainer, right? Go buy the stock, but remember what we said? You can buy the stock, but if the price stays low, you're not making any money. So what is the trigger? What is the catalyst that causes you to actually make money? With Embraer, I'll tell you what the catalyst was. You had 8 quarters of earnings following 2003, whereas the rest of Brazil, because that was a pretty turbulent period between 2003 and 2004. In fact, it started right after Lula was running for office, and Brazil went to, everybody in Brazil seemed to panic and sell stocks. You tracked Embraer's earnings for about 8 to 12 quarters, and you compared it to the earnings at other Brazilian companies. What you noticed was remarkable stability in Embraer's earnings, because they were selling in an outside market, they were charging dollar prices, they were able to keep their cost structure fairly controlled. So quarter after quarter, you'd see other Brazilian companies, being volatile, and Embraer's earnings reflecting the stability of its operations. It took a while. It took about 10 quarters before the market caught up with me. Because I did buy Embraer. The market caught up, but 2.5 years after the fact. But here's the flip side of it. If you have a low lambda, is that a good thing? Depends on whether country risk is going up or going down, right? What do we say happened to Brazilian country risk between 2004 and 2008? It dropped. In fact, Embraer has been once it went up, it kind of stagnated there because unlike the rest of the Brazilian companies that could benefit from lower, there's not that much upside from country risk. So if you're buying Embraer, buy it because it's a good aerospace company. It's not a good country risk play. Okay? But a lot of investors say, if I buy an Indian company, if you buy Infosys, it's really not a good country. If you want to buy a country risk play, buy Tata Chemicals. Don't buy Infosys. That's basically the lesson here is there are some companies you buy because they're good companies. They do their business well. Other companies you might buy because you buy into that country's risk going down or going up over time. Any company with a low lambda is not as good a country risk play as a company with a high lambda. So, as I said, I'm going to leave you to think about that because it is not conventional practice. So if you're going to do it, be willing to defend it. Right? So your managing director is going to say, well, what is this lambda thing? Where did that show from? don't say Damodaran told me to do it. Right? It's not going to fly. Or maybe it will, but then I have to deal with the questions. He's going to call me, you know. So think through it yourself. If you're convinced that it's a good way of thinking through things, use it. If not, don't. Right? So it's, you know, there are the other fallback approaches. Yes, Malik.
What would the R squared or perhaps the standard deviation were
On the lambda regressions, same as a beta regression. It's going to be 20 to 25%. The standard errors are already going to be 0.1, 0.15. So it's going to look just like a beta regression in terms of the noise factor you have in there. That's why I said you got to take the lambda regressions with a grain of salt and think about ways of refining those regressions. But then again, what do you think the standard error in using a lambda of 1 is? Which is what you're doing, right? The conventional practice, it's not, see, when I do this and people say, well, how come you're using a lambda of 0.27? It's a big standard error. I say, what do you think about using a lambda of 1? And they say, what lambda? We're not using, that's exactly what you're doing. So basically, don't let the perfect be the enemy of the good. Don't let people say, well, that lambda is a high standard error, so I'm going to go back and do what I wanted, because you are implicitly using a lambda of 1 then for every company. And I'd wager that that lambda has a much bigger chance of being wrong than at least you trying to come up with different lambdas for different companies. Okay? But so far, we're still working within the rubric of historical data, historical risk premiums added on. And as we said, we're at a break-in point where that historical data might no longer be relevant. What we might ultimately care about then, or care about when we do valuation, is what's the implied equity risk premium now? Now as in 226 today. That's how volatile equity risk premiums are. So what I want to talk about is something we mentioned, or kind of covered in corporate finance, but not in any depth, which is implied equity premiums. Every day when you open up the Wall Street Journal, you are getting a sense of what the equity risk premium is there at that point in time when you look at the S&P 500, or when you look at the level of an index. Because when people price stocks, they're bringing in their risk into the pricing, right? The way I describe this is I'm going to watch what you pay, not what you say. So I can ask you, what's your equity risk premium? You could throw a number out at me. But it's just a number. But if you show me what you pay, you're telling me through what you pay what your risk premium should be. In fact, the analogy I gave in corporate finance still works. If I come to you with a bond, an 8% 10-year coupon bond, and I told you that the price you're willing to pay for this bond is $950, you've told me what risk premium you're charging on this bond, right? How? I have the price. I have the promised cash flows. I solve for the discount rate that makes the present value of my cash flows equal to 950. In fact, in fixed income, what have I just solved for? That's yield to maturity in the bond, right? You're saying, what's that got to do with the risk premium? That is, in fact, the risk. You take the yield to maturity, subtract out the risk-free rate. You've given me what you demand as a risk premium. You're saying, but that's for bonds. You can't do that for stocks. Why not? In fact, let me go back to January 2008, which might seem like a cop-out. You're saying, you're avoiding that whole year. No, I'll come back and deal with it frontally, but let's look at the world as it used to be. January 2008, if you bought the S&P 500, you'd have paid $1,468.36. Look at it and weep. Because what's the index at right now? 815, 820, somewhere around there? Right? 1460. But on that day, that's what you'd have paid. Since you're buying a bond, you bought the 500 largest market cap stocks in the US, right? Unlike a bond where you get a coupon with stocks, what do you hope to get? Dividends, maybe stock buybacks. Unlike a bond where the coupon is fixed, I can't tell you what the dividends and stock buybacks will be next year, but I can tell you what they were last year, 2 years ago, 3 years ago, 4 years ago. In fact, over the last 7 years, prior to 2008, stock buybacks and dividends on the S&P 500 had amounted to about 4.02% of the index. So, in fact, in 2007, stock buybacks and dividends amounted to 5.5% of the index. So that's a huge year for buybacks. I've kind of averaged out some good years and bad years, 4.02% of the index. So I can tell you what buybacks, the cash flows, have been historically. And then I add a layer of estimate to it. I looked up one final number. You go to Zacks or IBES or one of these estimation services, even Yahoo Finance. They have an estimate of growth in earnings for the S&P 500. And in early 2008, that number was 5%. Basically, analysts were projecting a growth of 5% in the S&P 500 for the next 5 years. Now we can debate, is that the right number? In a sense, you want to use the analyst estimates because you're trying to build in based on market expectations what the risk premium is. So if they're overestimating a number, you want to use that overestimated number. You don't want to replace it with a realistic number. This is not about, is this the right value? You're saying, given the value and given these estimates, what is the risk premium that's built into prices? So this is the growth in aggregate earnings on the S&P 500, 5% a year for the next 5 years. Beyond the 5th year, I'm going to bring that growth rate down to a steady state growth rate that I can maintain forever. And I'm going to set it equal to the risk-free rate. We'll come back and talk about this, but I think that's a good estimate of stable growth forever, is essentially to set it equal to the risk-free rate. So I've earned these cash flows going at 5% for the next 5 years and 4.02% a year forever. What is the question I asked you with the bond? What discount rate makes the present value of your cash flows equal to the price of the bond today, right? Here are my cash flows, growing forever. There's what you paid. I ask you the same question. What discount rate makes the present value of those cash flows equal to 1468.36? Trial and error. You can get that. It's a little messier than a bond math problem because the final number, the terminal value number, is going to be a function of what your discount rate is. You can use a solver function in Excel, the goal-seek function, whatever, but you can get there. And in fact, in January 1st, 2008, the number that I've come up with as the expected return on stocks would have been about 8.39%. What does that tell me? If you bought stocks in January 1st, 2008, I don't care what you hoped you would make, what you thought you would make, what you prayed you would make, you were pricing stocks to earn 8.39% a year in the long term. Subtract out the risk-free rate that day, which coincidentally happened to be equal to the growth rate, you come up with an implied equity risk premium on January 1st, 2008 of 4.37%. See why I'm being specific about it being January 1st? Because when you wake up on January 2nd, will this number change? Market opens. In fact, let me do a few what ifs. So is everybody clear on the mechanics of what we're doing? We're just taking what we do in bond math and applying it to equities, replacing coupons with cash flows and computing a yield to maturity in a sense of the bond, an internal rate of return of the bond. So tomorrow you wake up. Let's assume market opens up 10%. Can happen, right? First day of the year, people come in, they start buying. Holding all else constant, the market goes up. What's going to happen to the implied equity risk premium? Think in terms of bond math, it's much easier. Bond price goes up, what happens to yield to maturity? Yield to maturity goes down. Stock prices go up, holding everything else constant, implied equity risk premiums come down. Stock prices come down, implied equity risk premiums go up, which actually is more consistent with intuition because why do people sell off stocks? They get scared, they get panicked, the implied equity risk premium will go up. Unlike the historical risk premium, implied premiums intuitively move in the right direction. That's assuming nothing else changed. What if the price didn't change, but earnings, this is tougher to do because how does earnings jump 10% in 1 second? Let's assume everybody wakes up, oh my God, earnings are going to be 10% higher. Holding all else constant, if I keep prices fixed, the index stays at the same level, but earnings are now 10% higher. What's going to happen to the implied equity risk premium? Same present value, higher cash flows. That's going to push down the discount rate. The implied equity risk premium is, it's going to go up. It's going to go up. I'm sorry, it's going to go up. Never mind, I got turned around here. It's going to go up. What if both change? Both the index and earnings up 10%. Think of the math. You multiply through everything by 1.1. Nothing changes, right? So here's the thing. Just because markets are going up and down doesn't mean implied premiums are going to change. But if markets go up and down but the fundamentals are not changing, implied equity risk premiums are going to change fairly dramatically on you. So implied equity risk premium is a day-specific number, right? January 2nd, January... In fact, forget about days. It's minute-specific number. Each minute of every day, your implied premium is different depending on the inputs. And the input that's going to change the most is the level of the index. That's the input that could in 1 minute change 15%. So let's move forward 1 year. It's been a tough year, we all know that, right? This is January 1st, 2009. The index is now at 903.25 from 1468. That's the 37% drop in the index we saw last year, right? So now January 1st, 2009 has arrived. You decide to buy stocks now. You think the worst is behind you. So you go out and buy stocks. The collective dividends and buybacks during 2008 that I'm going to use is 52.58. In fact, here's how I did it. I looked at dividends and buybacks every year, starting in 2001 to 2008. You can see that buybacks dropped off fairly significantly in 2008, from 67.2 to 40. In fact, the collective cash flow in 2008 was about 68.72. But notice how much lower it is than in 2007. And a lot of it happened in the last quarter of 2008. Buybacks in the last quarter of 2008 dropped by 40% relative to the buybacks in 2007. So I know what the cash flow was last year, 68.72. I assume that next year is going to be an even worse year. So I don't think anybody's going to debate. So I took the 68.72 and knocked it down. So taking that fourth quarter pattern, I applied it to the next 3 quarters. So I'm starting with a cash flow that is significantly lower than what it was in 2008, and even more significantly lower than what it was 2 years ago. So I'm at least trying to confront reality. Next year, I'm not just taking last year's cash flows and throwing them out. I'm saying next year's going to be a pretty bad year, and this is what the cash flow is going to be. That number matters because that's going to be the starting point for my projected cash flows. Analysts are still projecting positive earnings growth. Maybe they're inherently optimistic, but they have lowered from 5 to 4%, so thank God for small blessings. So now the cash flows, the lower cash flows grow at 4% a year for the next 5 years. Beyond the 5th year, the growth rate I use is 2.21%. Why is it so low? Because my risk-free rate has dropped from 4.02 to 2.21%. It's a self-correcting process. I'm making sure if I drop one, I drop the other as well. So I ask the same question. I now know the new level of stocks. I know 3.25. I have my expected cash flows. If I solve for the internal rate of return, I come up with 8.64%. That doesn't look very different than what it was 1 year ago, right? But the risk-free rate now is 2.21%. Take the difference. The implied equity risk premium on January 1st, 2009 was 6.43%. So we went from 4.37 to 6.43. Is that an unusual year? Sounds like a stupid question, but humor me. Of course it is. But here's the evidence that it is an unusual year. I went back and graphed the implied equity risk premium every year through 1960. Look at 2008. We've just hit a risk premium level we've never seen in history. The previous highest was 1978. And that took a whole decade to develop. We did it in 3 months. In fact, there was more movement in the equity risk premium in 3 months than there was in the previous 25 years put together. That's amazing in a mature market. In emerging markets, you often see this dramatic move. This is what makes this unusual is you've never seen this much of an equity risk premium move in this short a time period. I'm actually writing a new book. It's called Market Epiphany. Revelations from the Edge. I'm not kidding. I just made up this title as I went along. Okay? But I'm actually writing about things I learned between September and December that I did not know going in, or I thought I knew. Worse, I thought I knew going in, but now don't know. Okay? And I've actually been keeping track of every day, basically taking articles. I've been keeping, it's actually the most work I've actually done is collecting articles on different strange things happening each day. And one of the things I've been keeping track of each day is the equity risk premium by day. Because usually I said, well, how much can it move? And usually I don't do it more than once a month. But this was a point in time where if I computed the equity risk premium at 1 o'clock, by 4 o'clock it was defunct. Here's why it's unusual. This is a day-by-day computation of that equity risk premium. Okay? And let me be quite candid with you. The number that's not reflecting the change as much as I'd like to is that cash flow number, because I can't get updated dividends and stock buybacks every day. So there's going to be a little bit of a lag here in that process. But I was trying really hard. I'd visit the S&P website every day to see their announcements of dividend cuts, basically to try to build it in. So I did try to adjust. See the red line? That's the S&P 500. No surprises. That's you can see the market. So that's September 12th. That's just before, the weekend before Lehman went under, through January 1st. So there's the market going down. There's the implied equity risk premium. See these two lines? They're actually the wrong places. The average implied equity risk premium, so basically the numbers, for some reason, Microsoft Excel and PC moves my lines around. The average implied equity risk premium between 1960 and 2007 was 4%. Okay? So that's way down here. We're way up here. The historical risk premium is 3.88%. Last semester, when I taught this class, the crisis was unfolding. I still held on to my old recommendation. My old recommendation was use the average implied risk premium over the last 47 years because things seem to revert back to it. But I was comfortable doing that because you were at 4.39%. Suggesting use 4% was not exactly a daring move on my part. Now you can see why I'm a lot more queasy about letting you use historical risk premiums or the implied premium over the last 47 years, because we're truly seeing a break in history. This is unprecedented in terms of equity risk premiums in a mature market. You can even go back to the Great Depression. Okay? This is actually a remarkable move in risk premiums over a very short time period. Yep.
It's unprecedented, but you have to assume that this kind of breakthrough is going to steal forever because you are...
That's I think what I don't know. That's actually a good point, is if you ask me what risk premium should I use now, I have three choices, right? One is I can use mean reversion. Say, oh, everything's going to, this is just an aberration, in which case I will save you the trouble of doing a valuation. Because you know what you're going to find, right? You use a 4% risk premium now. What are you going to find with your stock? Dramatically undervalued. Everything is undervalued. In fact, there are equity research analysts who actually combine what I think is dynamite with a matchstick. They use low risk-free rates, because that's where we're at right now. They use historical risk premiums, and then they wonder why their valuations are so high. Because what have you just done? You're using a crisis risk-free rate, which is low because people are in complete panic. But then you're saying in the risk premium, oh, everything's going to be okay. We'll just go back to the average. Of course your numbers are going to explode on you. So this is the companion to what I said in the last session. I said if your risk-free rate is 2.21%, stick with it, but only on the condition that you update the implied equity risk premium. If you insist on going back to some historical average, then you're going to be on very dangerous ground using today's risk-free rate because you're combining two different views of the world in one number, and they're at war with each other. So implied premiums, I mean, you might not like the numbers I've used, but so go ahead and change them. They're on my website. You don't like the cash flows, try a lower cash flow. You think buybacks are going to be cut back even more, fine, go on and cut them back. Okay? But I think at least we're debating a healthy number then. We're not saying should it be 4 or 5. We're saying what should the risk premium be given what I think about the world. Now, historically, though, here's the other reason 2008, 2009 was so unusual. What was the last year where risk premiums were so high? What was the previous peak? 1978, right? But at least they had an excuse then. You know what the excuse was? The risk-free rate was in double digits. So you're saying, look, I demand a higher risk premium because my risk-free rate is 10%. And you can see the rationale for that, right? If risk-free rates go higher, 15, 20%, your risk premium should probably inflate. What makes this particular scenario so unusual is the risk-free rate is actually at historic lows, and we're looking at 1978 risk premiums. Historically, every 1% increase in the risk-free rate reduced the equity risk premium by about 0.15%. You're saying, where did that number come from? That's your weekly challenge for this week. And I'm giving you advance notice. I'm going to send you the numbers on risk-free rates and risk premiums, let you deal with what's the relationship been. So if you believe history, today's equity risk premium should actually be around 3% given the risk-free rate now. Instead, we have 6.43%. But let's complete the picture. Was it just equity markets that kind of flew off the handle? So let's look at a different statistic. I mean, one of the things that's always troubled me about trading in Wall Street is this compartmentalization. You're an equity guy, you're a fixed income guy. Never the twain shall meet. You don't talk to each other. It's almost like the two markets operate in different universes. But you buy corporate bonds, you're buying equities, you're buying risky assets, right? At least in theory, when you increase risk premiums for one class of assets, you should increase risk premiums for the other. So here's what I did to see if that relationship held. I went to the Federal Reserve website, and they actually have BA1 spreads going back to 1927. I didn't go back that far. I went back to 1960. BAA spreads. So basically, see this black line? Those are the BAA. So those are the spreads for the BAA corporate bond over the T-bond. So that's a risk premium in the bond market. The equity risk premium I computed using my implied equity risk premium number as the risk premium in the equity market. Most of the time the two move together. In fact, historically, the equity risk premium in the US has been 2.01 times the BAA default spread. That's a very easy way to get an equity risk premium then. Take the BAA spread, multiplied by 2.01. But there have been 3 points, at least in the last decade, where strange things have happened. See the first point? What happened in 1999-2000? People are actually charging a lower risk premium for buying equities than for buying a BAA. What was happening in 1999-2000? That was a dot-com boom. Right? Stock price. It actually was a stock market boom. Stock prices kept going up and up. So if I gave you those two numbers, as a rational investor, I said, you're going to make 2% buying BAA bonds, or you're making 2% buying equities, what's your reaction going to be? I'm not buying equities, I'm going to buy bonds, right? Bonds look cheap relative to equities. And of course, you get the correction, and then you get to about 2003, 2000, between 2000 and, after the 9/11, 2002. Notice the equity risk premium kind of stays pretty stable. In fact, it rises a little bit. During that same period, look at what's happening to bond default spreads. It's almost like you're in two universes. In the bond market, people are pushing down their default spreads year after year. In the equity market, the premium stays at 4%. So by the time you get to the start of 2008, you're seeing, in terms of a ratio, again, a very unusual number. Equity risk premiums are now 2.5 times the bond default spread, well above the historic norm. Again, some big story could have been told, but we saw what happened in 2008. The first phase of this crisis happened in the bond market, where default spreads, I mean, you view it as a subprime problem. Basically, it's a bond market adjustment. Default spreads start to. In fact, in 2008, I showed you what happened to equity risk premiums. Look at what happened to the BAA default spread. The BAA default spread is about 6% right now. It's almost caught up with the equity risk premium. Something's got to give here. Okay? What we have to hope and pray is what's a better give. There are two things it can give. One is the equity risk premium can go to 12%. In which case you can, remember the job offer you got? Throw it away. It's not going to be there, right? What's the better case scenario for you? The bond default spreads go down to 3%. Hope and pray every night before you go to bed, say, please God, let bond default spreads drop to half the equity risk premium, and let it happen quickly. Okay? Because this can't stand. This is not a tenable scenario. If I can make 6% buying a BAA bond, why would I buy stocks and settle for a little bit more? Okay. Any questions? Depressing thought, right? Come on, cheer up. Yeah? Good things can happen. Yeah.
I just wanted to link the Merton model to this. Actually, the bond is equal to a risk-free asset plus a put option on the equity. So you could actually argue that
only you could try for arbitrage. The Merton model works only in a very, very, very artificial world, right? You try to create arbitrage on it, it's going to be difficult. But you're right, it's a mispricing. Right? Are we done with that? Don't leave yet. I mean, you're starting to chat. I know it's getting close, but I have 3 more minutes. I can slip in 2 more slides. This is actually a fun slide, a slide that I know this is crazy to even think of it as fun. But how many of you are from real estate or worked in real estate? Okay. You know what a cap? Can you tell me what a cap rate is? In a house, when you price real estate, they use cap rates. Right? What's a cap rate? In other words, if I have a property with $100,000 net rental income and they want to value the property, they'll take the $100,000 and divide it by the cap rate. So if your cap rate is 10%, 100,000 divided by 0.1 gives me $1 million. So cap rate is like a cost of equity in real estate. So if I subtract the risk-free rate from a cap rate, what do I get? I get a risk premium for the real estate market, right? And when we bring that into the picture, we got a premium for the bond market, we got a premium for the equity market. Let's bring in the real estate premium and see if it moves in a different direction. And you look at this graph, you get 2 separate stories. First part of the graph, what do you see? Real estate seems to be doing whatever it wants. It's a different market. It's a foreign market. This is the days when real estate was actually a separate asset class. What's happened increasingly? It's starting to behave like a financial asset. So what do you think happened? Why is real estate starting to behave like the rest, the other risky asset classes? One is securitization, right? I mean, clearly, when you securitize an asset, you're starting to create some of the characteristics. So you're more. Second is investors are starting to think of real estate as an investment. I mean, let's face it, 25 years ago, most people who invest in real estate bought a house, and that's it. Increasingly, as real estate got, I mean, not just the big real estate, but other people started thinking about adding real estate as an investment. It's a good thing because the argument is, let's diversify, but in the process of diversifying, look at what we've done. We've made real estate into another risky asset class. So what happened last year should come as no surprise. A lot of real estate people say, well, usually when the financial assets do well, real estate should do. Real estate should do badly in the reverse. That's no longer true. Real estate is